I think it's very important because this is coming specifically from the SEC that Gensler's approach was just regulation by punishment, and now Paul Atkins, the new SEC chair, is really clarifying a lot of what we saw was wrong from the last administration from the SEC.
Welcome back to Network Spotlight, the Mick and Mike edition. Project Crypto changes how every builder and fund should think about launching in the US, and Coinbase just teamed up with JP Morgan. We're going to break it all down today. First of all, how are you doing, Mike?
Good, man. How was your weekend?
Weekend was good. What are your thoughts on this whole Project Crypto news that came out?
I think it's just continuing this trend of pushing forward the industry from Washington, D.C. And yes, the Genius Act was signed into law a couple weeks ago, and that's great for stablecoins and clarifies a lot of that. You know, the Clarity Act is still kind of being worked, but like this is specifically from the SEC. And as we all know, Gary Gensler, last administration was extremely hostile towards regulating crypto. And I think it's very important because this is coming specifically from the SEC that Gensler's approach was just regulation by punishment. And now Paul Atkins, the new SEC chair, is really clarifying a lot of what we saw was wrong from the last administration from the SEC. So that's why I think it's important because there's so much that just needs to be clear in terms of defining when a digital asset is a security or not, addressing a lot of the legal ambiguities there where the past approach was fill out this form on the SEC website and talk to us, right? When everyone tried to do that, right? Now they're clearly going to at least take steps forward to clarify when things are security or not. I've been part of projects that, because of the regulations, were forced to kind of do this decentralization theater. All right, let's spin up a foundation and then a labs entity, run the foundation out of the Cayman Islands or BVI, something like that, that essentially changed nothing in terms of how you operated at the earliest stages. But it was a lot of time and money spent to spin up these entities that, again, a lot of times really didn't. It was just theater. It was decentralization theater.
You mentioned the spending. That's the one thing that gets me excited about all this is the amount of just legal support that a lot of these teams needed to have in order to exist was insane. I mean, we talk about like Coinbase, Ripple, like the amount of money they had to spend on legal fees. So it is refreshing to have Paul Atkins, which is like a complete opposite of Gary Gensler, and to, talk about these things. But the other thing that you mentioned is this theater that you speak of. So like, what is the purpose for a lot of these entities? Like, what is the purpose of disguising itself as a lab or having an account offshore in British Virgin Islands?
Because it wasn't clear how you had to operate, how you could operate in the US. And this was essentially what a lot of the law firms that worked in crypto would suggest to do to cover all bases. In the early stages of a lot of these protocols that I worked for and many other people knew, many other people worked for and known, there was just a lot of this stuff that was just like a template that said cover your bases. You can have a services labs entity that does the development work, but then you have to have this foundation that's offshore, spend tens of thousands of dollars to do that, spend, hundreds of thousands of dollars on legal to just like rubber stamp this stuff. Like it was such a waste of time and money. It was all for nothing because it really did not change the way you operated. It was just checking the boxes on spinning up these entities to cover your ass, essentially. And now with this, hopefully these clarifications, you can, these teams can innovate in the US without being forced to decentralize prematurely just to avoid this regulation, right? So I think that's a great thing. As part of this, what I think is amazing is, and Hester Pierce, I think, was the first one to suggest this a while ago, is to kind of have this like safe harbor grace period where if you're an early stage builder, and look, selfish to deep ventures, we invest in the absolute early stages, right? Pre-seed, pre-product, and which is we don't want the teams that we invest in to have to worry about this stuff because it takes away from building the product, building their community,
Right.
getting product market fit. So now, if you have this like what they're calling innovation exemptions, this essentially this safe harbor grace period where they can focus on building their product, focus on building their community without having to worry about this regulatory burden, without having to worry about this decentralization theater. I think that is massive for the early stage age builder who has a team in the U.S. and wants the access to the best talent that U.S. offers without having to worry about all that cloud of regulation.
Yeah, the innovation exemption, that looks somewhat interesting, like having a grace period, because before the leash was not long at all.
No,
And a lot of times these teams were kept in the dark. And Operation Choke Point was at the forefront of all of that.
that too.
It was at the center, which brings me to the next story. But anything else to add on this, Mike?
Like you said, we've been talking about this stuff for a long time. Everyone who's in the industry knows what needed to be done. I think it's just, and you've got the different bills going through the Congress, but like for this to come out of the SEC, which is the regulatory authority that has been causing a lot of problems for the industry for many years, I think this is a big step forward, especially and will especially benefit early stage builders.
And institutions are pretty much going at full throttle. I mean, you look at this story here, Coinbase and JP Morgan Chase join forces to make it even easier to access crypto. So from what I gather from this story, Mike, is now like let's say you have your Chase credit card that you use, you can use the points to convert that to say USDC. So it just gives you more flexibility in terms of how you're going to be onboarded to crypto. You obviously now are able to connect your Chase account and transfer cash, but this gives you a little bit more flexibility.
You talked about Operation Choke Point. One of the biggest issues is on ramping to crypto, right? A lot of times banks did not allow users to on ramp to a centralized exchange like Coinbase, like Kraken, etc. And now you've got one of the largest banks and their 80 million plus customers, making it very easy to on ramp to Coinbase. You mentioned there's Chase points that you can redeem for USDC on Base. That's beginning in 2026. The ability to fund Coinbase accounts with Chase credit cards, I think that is happening in the fall. And then again in 2026, linking Chase bank accounts directly to Coinbase. So just making that on ramp to crypto much easier. And it's amazing. Maybe Jamie Dimon lives like rent free in my head on how he has been anti Bitcoin,
Yeah.
very publicly stating it is worthless. It's a scam. And they're going full throttle into crypto. And, I think one day he's just going to, actions speak louder than words, right? I don't know if he'll ever admit it that, that he was wrong about it, but he's certainly acting like he was very wrong about it. And he's coming around now.
And now he's saying that he's just doing what the customers want,
Yeah.
which
Yeah.
ultimately we all knew that's what he was doing. But now he's coming out. I guess the next step is for him to come out and admit, like, yeah, we're just doing what the customers want. And my
Yep.
question to you, though, is during this Operation Choke Point, there were a lot of solutions that came out of it, potential solutions on and off ramps. You've got like HarborFi and all these other startups that were coming out to provide this direct crypto to fiat solution. Do you think that with this news, and I'm sure this is the first domino to fall, there's going to be other banks that will be jumping in, but do you think this helps the case for other startups in providing that solution or hurts?
I think this is good. This is good for the industry overall. I think the easier that you can allow users to access crypto is a net positive overall for for the industry. I think that's pretty obvious. But like I think there are different flavors. This is specifically linking bank accounts to a centralized exchange like Coinbase. Now, um, they what's interesting is that if you can get them truly on chain, like what Coinbase is doing to Base, that's where it gets interesting. Next step, directly onboarding fiat to crypto into DeFi. Now you're kind of skipping steps, right? Now you're saying, let's bring these users on chain directly into DeFi apps for them to do lending, borrowing, to do swaps. I think that's when it gets interesting, right? So you're going to see other startups probably attack that area as well to bring people, on ramps, finding solutions on ramps to go directly on chain. So overall, I think it's a positive, but still, you're gonna find people up and down the spectrum of like how on chain, how decentralized do they want to get, and then solving that problem of on ramps to serve those users.
This is just a display of how some of these regulations that we were discussing in the conversation are really shaping how products are being created, solutions are being provided. And I mean, the same thing goes for this piece of news where Coinbase is planning on launching tokenized stocks predictions markets for the US users. So I think if we were just to read the first part, I wouldn't think this is big news. But the biggest point here is that it's for US users. And we've talked about on this show before how it seems like the rest of the world comes first, right? Usually like Europe and other parts. But now you have these solutions that are being offered here in the US. I mean, this means that other companies are going to be doing the same thing, of course, like Kraken, like Robinhood. And I mean, competition is stiff. What do you make of that?
Yeah. So a lot of times the US was always, like you said, like was always kind of it's the largest market, it's the wealthiest market. So the US was always the first target for a lot of companies, and then they would go ex-US. But because of the regulations, it was very difficult for a crypto company to break into the US market. And now it's happening everywhere. And Coinbase was was, if not the first, to just do everything by the book in the US. And to as a result of that is they've carved out the leading centralized exchange position in the US. And now, yeah, like you mentioned, tokenized stocks. Robinhood recently made their announcement that they were launching an Arbitrum L2 and had tokenized stocks, but it was I believe in the EU only. Kraken, who is going public soon, um, and them and Gemini also have these offerings, but outside of the US. So Coinbase being able to provide those in the US is carving out a nice position there. But I think there's a big battle brewing here in the US for the prediction markets. Kalshi has raised a massive round that we talked about in a past show, and they are licensed in the US. Poly Market has been mostly outside of the US, but they made an acquisition to be licensed in the US and recently had a distribution partnership with Twitter. And now you have Coinbase entering the market in the US. So yeah, there's definitely a lot of competition there, and I believe Kalshi also partnered with Robinhood as well for distribution. So yeah, obviously Coinbase has a massive distribution in the US. So yeah, there's definitely a battle brewing on that front.
Which product is getting you most excited about?
Any product that can get users on chain and onboard those users on chain. So if you're falling into kind of what we were talking about with Coinbase partnering with JP Morgan and bringing on potentially many users on chain, we are looking at those projects that can on ramp users directly to DeFi, which I think is super interesting. So I think we're seeing some of that movement happening. The importance of on ramping and off ramping, that's always been an issue in the past, at least in the context of what we've been talking about in the last 20 minutes. I think that's what I find most interesting and what I think has the biggest impact.
Good to know. Moving on, because you mentioned on chain, we do have some news about on chain, Mike, and that has to do with Ethereum. They just celebrated their 10-year anniversary. I can't believe it's been 10 years. I mean, Yeah,
It's
2015.
nuts. It's nuts.
And they've gone through so many different transitions. Starting off as a proof of work chain, now they are proof of stake, getting bashed during the bear market. It's been a long, long ride for the chain.
Yeah, but if you just look at the, like you said, the transition from proof of work to proof of stake, these massive, like the Pectra upgrade and these massive, massive upgrades, just the coordination that it took and like the technical prowess it took to do these upgrades, and they go off perfectly. Like it's just, it's such a feat of engineering that, um, and just the way that Ethereum is the first smart contract chain, it it led to, there was the DAO hack that was, an existential crisis. There were, but then, it brought in the idea of ICOs, of DeFi, of NFTs. Now, there's so much competition there from EVM chains as well as non-EVM chains. You've got the Solanas, you've got the Sui's and Aptoses, non-EVM chains, and like it just can't die. And at this point, it just won't die, right? It's got the Lindy, right? It's like, the longer that it's going to be around, the stronger it's going to get. And it's just a feat of engineering, man. A feat of engineering and human coordination. And yeah, I just can't praise Ethereum more, and just the people that work on it. It's just an amazing development in the world of not just crypto but tech overall.
They definitely have the advantage, like that first mover advantage, and it's still where the liquidity sits, right? If you're not
Yeah.
talking about Bitcoin, of course, it's still the bread and butter, so to speak. People argue
Yeah.
that Solana is, technically better in a lot of ways than Ethereum. And I think that there are a lot of chains, newer chains that are coming out where on paper they might be better in terms of just like user experience,
Yep.
cheaper fees. But there's this trade off where you have something new, but you have to get people that are using existing solutions to transfer over. And that's not a very easy thing to accomplish. So they have the first mover advantage. And, based on what Justin Drake laid out for the next, 10 years, I mean, they're working on some ambitious things, Mike.
They're in a good position. Like you mentioned, Solana. One of the things that, they an advantage they have had is that they've tended to move faster, right? Like in terms of like doing innovating and upgrades and things along those lines. And that's kind of the nature of the beast, right? Ethereum has really held strong to its vision of being this very open, very permissionless, maximum decentralization platform through and through. And that was the original vision that Vitalik had, and they've held on to that vision over 10 years, and they plan to, it seems like they plan to hold on to that vision for the next 10 years and beyond. But yeah, looking at what their Justin Drake from the Ethereum Foundation laid out, scaling the base layer, transaction per second to 10,000, right? Getting it to the scale of some of those much faster chains. And, maintaining decentralization and, one of the amazing things, 100% uptime, right? Like it's never gone down. And then, there's optimizations and upgrades they want to make across the layer one consensus, data availability, and execution layers. So yeah, definitely bold vision for, increasing speed of the base layer. We've had some conversations about what that scaling roadmap looks like as it relates to L2s, and now clearly they want to scale up the base layer. And yeah, I look forward to the next 10 years and seeing how the chain develops, and seeing how all the competitive landscape shakes out, because still there's still a lot of bit of work to be done, right? And I think we're just seeing the long-term kind of goals being hit in terms of like institutional adoption and real world use cases of blockchain. Certainly Ethereum is at the center of that, but I still think that there's a lot of the overall the market's going to continue to grow rapidly. There's still a slew of different products that can be built, optimizations to be made to the infrastructure, and I think the future is bright overall for Ethereum and the crypto industry overall.
Updates are ongoing, and a lot of that has to do with the fact that there is just a lot of development that is happening. The competition is stiff, and it's not easy to stay ahead of the pack. And on that note, Mike, you bring to us three different projects that have secured some serious funding. A lot of it is more tech focused, so these are on the cutting edge of technology. And today we're going to start with a layer one blockchain.
So Stable is an L1 dedicated to power instant low cost tether USDT transactions. They raised 28 million in a seed round led by Bitfinex, HackVC, and USDT Zero, with participation from Franklin Templeton, Castle Island Ventures, and others. This is what's interesting to me. This specifically with Stable. Bitfinex also backed Plasma, which we talked about in the past, that raised a massive, they did a massive public sale. I don't know exact number, but it was something like $500 million. Bitfinex is the kind of the tether exchange. They also backed Plasma, which is doing a similar thing, is optimizing USDT transactions. Like that Plasma's a little bit, but Plasma's got is like a Bitcoin sidechain. They're doing it in a different method, but like Bitfinex backed both of them, which is kind of interesting to me. They're both doing similar things. And to be honest, both of them are competing against Tron, right, which does the most USDT volume. So pretty interesting kind of competitive space there where Bitfinex is betting on a couple of horses that are doing a very similar thing.
Walk me through this just in the mindset of an investor. Is it just because they have a very strong thesis around stablecoins and that's why they're just trying to throw a lot of things at that specific area? Or what do you think is the thought process when you invest in two solutions that are slightly different, but overall are aiming to accomplish the same thing?
Here's my thought. It is when you're a big enough fund, it's difficult to not invest in competing protocols. Okay. Like if you look at A16Z crypto, they've invested in like, I don't know, 100 L1s and L2s, just like crazy. And they're essentially all competing against each other. But for these is like, this is like we talk about purpose built chains, that's kind of one of our sub theses. Like these are two very new purpose built chains built specifically for USDT. And yeah, I guess, you can hedge your bet on that in terms of you could just make essentially two investments, and you don't have to pick the winner, right? One, maybe both become good investments, but if one happens to win, you have exposure to that. And obviously, this is Tether backing both of them, both focusing on USDT. So that's my thought process. I think it's just with what they're thinking. They're kind of hedging their bets. They're getting exposure to both of these teams that are doing the same thing, and in the end, their asset is the one benefiting from it, and they can potentially benefit under every circumstance by placing their bets on both.
Would you say this is like a good message to like founders out there that are also potentially looking to secure funding for whatever it is that they're building, that if they're trying to target specific funds, just because they are already invested in that specific narrative doesn't mean that they would overlook you. They might want to double down on a specific thesis of theirs.
Yeah, that's tough, right? You really have to understand and look at the trends of that specific fund, and to see how open they are to investing in competitive products. Because also, like, you also don't know how they're supporting behind the scenes, right? So you gotta think about that, right? Like obviously, if you just look at a fund like the very very large funds that invest in multiple L1s, you shouldn't be afraid. If you're building a new L1 or whatever, you shouldn't be afraid to pitch those, because they're going to invest in competing protocols. But there might be others that smaller funds that don't have that, don't take that approach. So yeah, certainly you gotta kind of go on a fund by fund basis and do your research there.
Nice little insight from Mike of Deep Ventures. Thanks for sharing that, Mike. Transitioning over to Manifold.
They raised 10.5 million in Series A round, led by OSS Capital with participation from DCG. So they are a decentralized AI infrastructure protocol. But what's interesting is they run the Targon subnet on BitTensor. So essentially, this operates as this transparent marketplace for GPU compute. Now we're talking about, kind of in the same vein as like Render, Akash, but they're running this service on BitTensor. And if you don't know, not familiar with BitTensor, it is this very meritocratic AI ecosystem that essentially the emissions of its native token, Tau, is dedicated to these subnets essentially based on the value that they provide. There's within each of these subsets, there's like miners that do the work. So in this case, miners would provide these GPU compute, and then there's validators that like validate the work that lead to these emissions to the subnet. So what's interesting is that over the last couple of weeks, and there have been these fundraisers for these subnets, and we actually invested in a subnet called Yanez that's creating synthetic ID profiles, and they're running a subnet to power their SaaS offering. Like, yeah, so now there's two of these subnets that have raised money from VCs in the last couple of weeks, and I think that's a cool trend. That's a very cool trend. They're raising venture money to accelerate the development of these subnets and push these AI tasks moving faster and get them done faster and create better products. So Manifold is focusing on this overall GPU compute marketplace, but they are running it on BitTensor instead of their own protocol.
When you look at this piece of news, I mean, are you getting more excited about BitTensor as a whole, just in terms of like all the development that's happening on the subnets?
100%. Yeah. I think it's just it's a non-traditional way of doing it, even in crypto. And BitTensor recently, I think in February or March, went through a redesign and of how these subnets get these emissions, and now there's tokens that are like each of these subnets has their own what's called an alpha token. So there's a market being made there, and that market is very much linked to the activity on that subnet and the value that it brings. So I think it's a very, very interesting way of AI development to be done. And there's also a lot of potential of collaboration in between these subnets that kind of bubbles up the overall AI industry even more, as opposed to some of these protocols kind of try to do it themselves. So yeah, there's a lot of interesting dynamics going on. I've been digging into the BitTensor ecosystem for the last couple of months, and yeah, I'm really, really bullish on how it's still very early in their new design. And I think there's some things that need to be worked out, but I'm really bullish into the direction that it's going.
We've got Ting, who used to be at Delphi Digital. He's in the community, and also he actually came on one of the episodes to talk about BitTensor, and he's very much like big into AI and has been doing it before it even became popular last year. And he's very bullish on what BitTensor is doing as a whole. So
Yeah,
that's
yeah,
really good to see that the development is continued to happen. And I'm sure that will also translate to a lot more excitement around Tau as well.
yeah, absolutely.
When you first brought to me this next project, I literally thought you were bringing a hotel chain, but Courtyard, the .io is, looks like an NFT marketplace. Or is it more than that?
So it's is a physical collectibles marketplace that turns what I think are like true real world assets into NFTs. So Courtyard, they raised 30 million in a Series A round led by Forerunner Ventures with participation from NEA, Y Combinator, and others. And like I mentioned, they acquire physical collectibles such as trading cards, other sports memorabilia, vintage items. They house them in vaults, and then they turn them into digital assets like via these NFTs. So increasing their liquidity, you can get fractional ownership. But what's being able to have the provenance of those real world assets is one differentiator, but also they've done a lot with like account abstraction and easily on ramping new users to their platform to be able to get the traction that they have. So yes, you are partially correct in the sense that they are NFTs, but these are all linked to what I call true real world assets, as opposed to like real world assets like stable coins or treasuries, etc. They have grown rapidly. I think they launched in January 2024, acquired like only 50K in sales volume, but in June they've done 70 million in sales volume. So they've grown rapidly, and it looks like they've raised a big round to continue that success and get many more real world assets on chain.
We haven't talked about NFTs in a long, long time on this episode, or I should say on this channel. And a large part of that is because NFTs, just that word, like people just don't get excited about it. They talk about RWAs, real world assets. But what would you say for something like this? Like, what is the main reason why you would want to have an NFT, which represents an actual physical asset? Is it more of just to prove that you have ownership? Is it more like in case there's like a club, like a membership club, if you own certain things, you can, have access to it, and this is proof that you physically owned an asset?
Yeah, there's that, but also it facilitates fractional ownership of certain assets. You're able to.
Here's the thing: fractionalize what? Like, if you have a physical asset, what are you going to do? Cut it in half and send the other half to the other person?
No, you'd be able to own a piece of that and sell the value to that to someone else. So if you have like a signed football, let's say from Tom Brady, from let's go with Eli Manning, since I'm a Giants fan, from one of the couple of Super Bowls that he won. If that, as it grows, let's say that's, that was like last auction for 500K. As time goes on, you can, but I'm not going to buy a 500K, football, even as much as I love the Giants. But as that, in 10 years that might double, and maybe I could buy into it, with 5,000 right now, and 10 years that doubles to 1 million. My 5,000 is 10,000. I can sell that piece off to someone else. So fractionalizing that is not necessarily cutting that piece of the leather of the ball, but it's fractionalizing the value that can go up, and I can get in on that at a level that I'm comfortable with, but I want exposure to that asset and being able to sell that down the road, because it's more liquid, and the NFT proves that I own a piece of that.
So the actual physical asset remains in the vault. And let's say you and I are co-owners of this football. Neither me or you would have it in our possession. It'll be stored in this real physical vault.
That's right.
Okay.
Yeah. Now, if someone wants to put it, on a shelf in their house, they're going to have to buy it from all the fractional users. I don't know how that transaction might be facilitated on Courtyard, but they'll have to scoop it all up and then redeem it from Courtyard to put it on their mantle somewhere. So maybe Eli wants to do that, right?
Yeah. Oh, I'm sure, and he's got the money to do it too. But it's really interesting to see this evolution of the marketplace. We started, like, I remember last cycle with forgot the name of the company, but they were doing scenes, right? These moments from basketball games, football games, and it was all digital.
It was NBA Top Shot, right? From Dapper Labs, yeah.
Dapper Labs, there you go. Yeah, and that was pretty cool, but I think many people still didn't get it because there was no physical asset attached to that. Now you're making it a lot more interesting for people that have never been exposed to crypto, blockchain. They don't know anything about that, but now they understand that, okay, this is a digital asset that is a representation of something that I own, and it's proof that I own it. So I'm excited about this next evolution. We covered it all, Mike. We talked about the regulatory framework, and we're seeing in full, just real time, how that's playing out, from Coinbase partnering up with JP Morgan and just providing more solutions. And then these 3 startups that are doing really good things in crypto. Thanks so much for bringing that to us. You put out a newsletter every month talking about these types of projects and just this cutting edge technology. So recommend those that are watching, if you found this video helpful, first of all, like the video, subscribe to the channel, But also give Mike a follow on X, subscribe to the newsletter, and also check out networkspotlight.io and apply to become a member. If you're a founder or operator in Web3 and want to connect with others like you, head on over to networkspotlight.io and apply to become a member. See you on the inside.